Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Michael has another one, Jack, and he says, are you forgetting about the size of the U.S. debt? And Barbara's question is, how will that affect this, all this craziness? How is this going to affect the U.S. stock market? Obviously, none of us really know, but if it's deflation, then we're basically sitting here quite possibly with a Dow of 11,000 high, right? I mean, I don't think stock markets like deflation, do they?
I don't think not this type, because if this type that we're talking about is a global and profits generated, the multinationals, the globals, the biggest game in town. So no, and we're not forgetting about the government debt. In fact, that's a big part of this, because of all the government debt pumped out by all the major G7 countries, Canada the exception, to a degree. The relative productivity of the economy is falling tremendously, meaning you have subpar growth in the future because the government is eating the private seed corn, so to speak. So that's all part and parcel to this undercapacity growth, we think, for many years, which is again a deflationary impact. You don't have the pricing power for that. So that's so it's bad news, because deflation, as we know, is very bad for creditors, and creditors are the ones that are which means the banks are not going to put more and more money into the real economy where it needs to get, because of this deflationary problem and lack of relative high yield projects. So it all goes together, that whole government debt problem. We haven't forgot about that. That's part of our deflationary scenario. People think that because high debt right away it has to be inflationary. We say this again and again. Look at Japan. Japan went from 70% debt to GDP, I don't know, maybe even 50% debt to GDP when their economy started plunging in 1989. They're now at 200% debt to GDP, and they're in the worst deflation they've ever been in at the moment. So don't buy into this idea that high debt means inflation. It does not.
No. I think we lost trillions, didn't we, Jack, in the last couple of years in the credit crisis?
Yeah. It's been a massive a massive hit, and that game is still going to continue because we were so over leveraged, we think.
Right.
And again, that private deleveraging is outweighing the public side of debt being put into the market, and that's why the stimulus isn't stimulating.
TJ has a point. He says, what's the strong dollar going to do for stocks? Is there if you're an equity investor, you see the dollar going up, is that going to be good for the U.S. multinationals? Does it matter because they're global? What do you think?
It just depends on the environment. If the dollar goes up on a major risk aversion, then obviously that's bad for stocks. But if the dollar goes up on global growth, it's good for stocks. There's a great article, if people want to go to it, written by Richard Byrne, the head economist from Morgan Stanley. And if you send me an email, I'll send you a link to it, or I'll send you the article. And he talks about the change. People are so concerned the dollar's going up in value, corporate earnings are going to be hit, but it doesn't happen that way. I mean, that's just for people to come trot it out on CNBC and scare people about. But there's been it goes to the trade-weighted dollar, and it goes to the idea that exporters don't want to lose market share, plus they hedge and other things. So it's not direct, and it's actually declining the impact of a rising dollar. The negative impact on earnings is declining. So at this stage, we would say don't really buy into that strong dollar, corporate earnings in trouble idea. We think the dollar will continue to rally once we get through this on global growth. And the fact is that the U.S. penetration of exports has has been very, very good over the last several years, meaning the penetration, sending exports to the emerging market areas in a very big way. So that we think that all is beneficial, and it will be the type of scenario that we saw in the 1990 to 2002 bull market, and this is our positive view of the world once we get through this, and that the U.S. is going to pull in a lot of assets because the assets look relatively cheap. And if you have a growing economy and the Fed finally gets out of its own way, which we think it's going to move obviously faster than the Bank of England, Bank of Japan, and the European central banks, so the yield differential is going to tend to increase. We can see a money flow to the U.S., pushing the dollar up in kind of a self-reinforcing process on stronger U.S. corporate exports.
Interesting. And the last point, at least unless somebody else has another question, because Jack's going to have to go, but would you mind just expanding on your currency cards this morning? Gold and dollar. Jack, how long is this correlation going to play out? They're both moving the same way.
Yeah, we were trying to make the point, and again, you hear analysts say that if gold goes up, the dollar is going to be crushed, or if the dollar goes up, gold's going to be crushed. And historically, if you look at the very long-term patterns, because gold and the dollar are mirror images for good economic reason, gold is priced in dollars, the world reserve currency. If the dollar weakens in value, the relative dollar price of gold has to go up. But during periods of global, distress, you see people moving into the gold and the dollar, and they move together. So the question is, how long are we going to have this risk out there in the world? So who knows? Maybe we have, the euro continues to create systemic risk for 6 months. China breaks down. We see the dollar and gold going higher really on the same type of thematic of kind of safe havens. People that don't want to necessarily go to the dollar but want to get money out of these other areas are going to go to gold. So that's why we see them move up together at points in times, as we did during the credit crunch. The dollar went up and gold either stayed flat or went up slightly at the same time with the dollar when every other asset class fell. The point we make is, or we made in there, was using some arguments to somebody else, but arguments we've used before, is that gold doesn't compete because it pays no yield. So when there's relative liquidity on people's on financial institutions' balance sheets and other and other big players, and they don't have real asset investment opportunities, gold looks like a good storage place for that money. But if the world starts to normalize and we get through these risks and the rates start to increase, the yields start to increase, and there are real economic opportunities for capital investment, we think that money is going to come out of places like gold and go into the real economy, also stretch for yield, and gold will start losing the game as interest rates start to rise, and we think the dollar in that scenario of global growth continues up and gold breaks. There's a whole lot of questions and a whole lot of thoughts on what happens to inflation, what happens to government debt, and they're all real questions. We would have had a written, a 500-word, 500-page dissertation, but that's our general global macro view, and the idea that that sooner or later they will decouple again, and our thought is that when they do decouple, it will be dollar beneficial and gold negative.
Interesting. Jack, I have a question for you. It seems to me, maybe this is me, that the central banks seem to take a lot longer to make these decisions that seem, I hate to say that they're so easy, I'm sure they're not for political reasons, but, for instance, the Australian central bank raises rates, and the other day, a Canadian central bank raises rates, and it seems like we're going the other way. Everyone else is talking about deflation, and these guys, Australia didn't do it recently, but they've done it in the past, and Canada just raised it. I mean, it seems almost backwards. Jack, what do you think?
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.